Welcome to Global CIO Symposium, Paradigm Shift, Global Investment in a Restructuring World, brought to you by VS Partners and Financial Times Chinese. I'm Selena Lee. Joining me today is Karina Fang, Portfolio Manager and Chair of Sustainable Investing of Brown Advisory, one of the ESG pioneers in the US with fully integrated sustainable investment process and a strong team dedicated to ESG research. Karina is among Barron's inaugural list of 100 most influential women in finance, and she's recently nominated as a candidate for PRI Board of Directors. Congratulations and welcome, Karina.
Thank you so much. It's great to be here.
Yeah, VS Partners is one of the first independent OCIO company based in China that invests globally with local depth. Its tenet is to invest for the betterment of the world, and that ties back nicely to our topic today: how public ESG investors generates impact without compromising performance. Could we start by having you tell us about the changes you have witnessed in sustainable investing space? You basically have devoted your entire career to it, and that must be an exciting journey witnessing it becoming mainstream.
You're absolutely right. It has been, it's really great to look back, and it's important to acknowledge how far we've come. I mean, I've been in investing roles for 20 years. Before that, I was an engineer working on environmental technologies. So I've seen this space evolve. I've seen it be called different things: social responsible investing, green, clean tech, ESG, impact, and those acronyms actually have changed over time, like what SRI means, for example. And, we've really come a long way from, say, screening out the bad guys to actually, there are some approaches where you actually buy shares in a company in order to engage and hope to change their behavior. And then other investors might participate in order to make a social or environmental impact. So there are various reasons why individuals and institutions may want to participate in sustainable investing, the sort of that big umbrella that I think takes into account a lot of different approaches. And by now, the great thing is that we know that there's a lot of room for different and high quality approaches. And so at the highest level, I've seen, again, individuals and institutions, engage with sustainable investing for at least one of three reasons. They either want the performance aspect, they want to make money, or they want to align with their values, or they want to make an impact. And, these are all worthy goals, and I think all achievable. Performance is where my team and I are focused. And as long-term, high-conviction investors, we just believe that the sustainability lens is more information. It helps you turn over more rocks, look at more information to just answer the basic questions of how does this company make money, and do I want to own it for the long term? And long term, that is the key that we believe requires a sustainability lens, because arguably, our operating environment isn't getting any easier. That operating environment includes political surprises, financial shocks, a pandemic. It also includes the natural environment and all those associated resource constraints. And I think that a positive change over the years has been that that all of this information, it's qualitative and quantitative, that's relevant to making an investment decision. Is this a company? Is this a multi-generational business that's prepared to thrive in that arguably, very, very challenging, increasingly challenging operating environment? So what I think we've seen, and we're going to continue to see more of, is that sustainable investing is increasingly not going to be regarded as, a separate situation, but what you said, that it really is mainstream. And my analogy is, do you remember when the internet was an investable theme? We bought internet stocks, and I don't get the question too much anymore. It does happen sometimes. Is that an ESG stock? That's not quite the right question, I believe, for investors. And so really, I think we just have to assume that a sustainability lens is applied, or at least is important. Now, but this, sort of gets us to the challenges, that there are no approaches to ESG and sustainability that are all things to all people. Remember, people want to make money. align with their values, or make an impact, change the world. Clients need to have the information to decide for themselves whether an investment, meets their criteria. And, again, those names, the acronyms and all that will continue to change over the years. And just, the good thing is that we have a lot more data. There's more transparency, but, an impact report and greater transparency doesn't necessarily mean a high quality, long-term, high conviction investment approach.
True. As you just mentioned, investors actually are adding a sustainability lens to their investment, but not everyone asked the right question. There are still misconceptions within this space, and perhaps you can let us know what are the some of the questions you got asked that you believe that are not the right ones, and what would be your strongest argument responding to those allegations? For example, people would say that, are ESG investments compromise my portfolio return?
That used to be my number one question, I think. But, over the years, and, we've run my strategy for almost 12 years now. This notion of a trade-off with performance, I think, has definitely just been put to bed because of data. I mean, luckily, my co-portfolio manager, David Powell, and I on our large cap sustainable growth strategy, we are in good company. There are now other managers that have, 3, 5, 10-year track records that have really, provided some relative, and attractive performance by incorporating ESG and sustainability. And it's not done in a monolithic way. So another misconception is that, that this is a monolithic industry, and at best that's inaccurate, and at worst it's sort of undermining. To the performance question, just as traditional investing, you've got some good and average and bad investors, the same thing happens with, any other investor, that incorporates a sustainability lens. So I would actually tamp down the expectation that an ESG factor, so getting to a third area of misconception, that there are these factors out there that we can identify about the ESG-ness, good or, thumbs up or thumbs down, about, 10,000 companies in a universe, that will sort of automatically lead to, good or bad performance. ESG alone will not make you money, and it will not lose you money. There's no singular set of even fundamental data that will do that for you, right? Like, you're not going to ask me to build a portfolio of just, the highest free cash flow companies and expect to win because, they might not be reinvesting in their business. I mean, there's just no singular set of frameworks. There's no decision you can make in a vacuum based on, hard and fast data that can help you understand if a company has high barriers to entry, or if they've, done at least the work to ensure that their physical operations are resilient to climate change, that their supply chain is, that they have a holistic view on sustainability. Now, you can call these ESG risks, you can call them fundamental risks, or existential risks, So, my strongest argument about, to address those misconceptions is that, just number one, why wouldn't you want to use, more information from a lot of different sources, both public, proprietary, et cetera, including the sustainability lens, to just gain more investment insights, right? That's the job of an analyst and investment manager, turn a whole lot of information into investment insights. And then number two, like I said, the data is there that there are managers that can outperform for long periods of time. Same on the fundamental side.
Yeah, so there's definitely no panacea for all different kinds of considerations out there online. So I guess it's a very interesting process for you to come a long way and actually coming up with your own approach to this. But I guess all across the world, a lot of the PMs are facing this great change, which is the pandemic. And COVID-19 has changed the way we work, how companies operate their business fundamentally. And what was the effect of the pandemic on sustainable investing? And especially you yourself are known for basically picking the stocks with the best long-term durability. Have they survived the pandemic, and has it prompted you to make fundamental changes in your approach originally?
Yeah, good question. I mean, wow, amidst all that volatility and, frankly, bad news, throughout the pandemic, we have been happy to see that a lot of our companies have really been shining as they've been proven to be able to be responsive to employees, customers, and many of them actually play a pivotal role in the overall coronavirus mitigation effort, how to understand and then get on the other side of this pandemic. I think that's just thanks to strong business models, especially good management. I mean, just leadership was definitely tested during the pandemic, right? And our process, frankly, was also tested. You asked, if this prompted us to change our process. And as it turns out, companies that were already positioned, to be responsive and accountable, to their employees, to their customers, to their whole ecosystem. Those are the companies that have managed well through this. But the crisis really, we did learn from it, and I think it put three management issues into the spotlight. Again, you can call these ESG issues, but I think they're just like fundamental and leadership and corporate strategy issues. So that is, how have companies been managing their human capital? How have companies been supporting their customers? And then how are companies continuing to invest to provide solutions and innovate, throughout all this turmoil? So, of course, the risk is that companies can't do this and they come out weaker on the other side of all of this. But this is actually when I think these leading companies were able to prove themselves and really take market share, especially now that we're a little closer to a new normal for businesses. So, just as an example, being responsive to your employees, that's so important when at a time when, a lot of companies actually, they did not, or they could not, perhaps because of a weak balance sheet, treat their workers well and provide paid leave. But that is something that we watched closely at the beginning of the pandemic. Companies can find it pretty easy to lay off or furlough workers, but then a lot harder right now as we're trying to hire them back, right? And, there's other aspects that are important too. Again, pre-pandemic, offering workers a sense of job security, physical, health and safety precautions, et cetera. And, if anything, seeing, how leadership responded to this crisis, it's reinforced our commitment to our longstanding ESG approach. We certainly have a number of portfolio holdings that have COVID tailwinds because they've provided solutions, but we chose those companies using the same selection process that we've always had with many in the portfolio pre-COVID.
Right. Definitely the winners coming out from this global pandemic are the ones that are more adaptive to a changing environment, and maybe, as you just said, gaining momentum from that tailwind, actually having transformed their business to be more adaptive.
We've definitely seen that, yeah.
Right. And you see in the US, we still consider that US and perhaps European markets are more advanced in terms of like developing an infrastructure that are more conducive to ESG investment and allowing asset managers and PMs like you to incorporate those considerations while investing. But those aren't always the case in other parts of the world. Perhaps, in other markets, you've seen absence of robust listing company ESG disclosures. And, as we see some of the exchanges try to stepping up their efforts, we still don't see those ESG disclosure requirements are up to the standards we see in the US. So with that sort of status quo, what asset managers operating within those markets, what they can do to improve the quality of data. Perhaps you could share with us a few tips for those who are investing in emerging markets, perhaps where the ESG adoption overall could be a little bit slower at the moment.
So as companies start on this journey, it's important to understand what is material to them and what do they want to express to which stakeholder. And again, not be all things to all people and fill out every data point on each framework. I also think that it's important to be open to evolving best practices. You need to stay ahead of the frameworks that you may be required to or requested to report against. But calibrating that with what is most material to your company. Again, it could be, an internal operational footprint and the carbon footprint that, a company is most focused on. It could be another company could really be focused on their diversity, equity, and inclusion journey. And that even has different flavors. For your company, is it increasing representation at the highest decision-making levels, or is it at the front end, increasing that funnel? So decide what's important to you, what you're working on, and help investors understand your own journey, what your priorities are.
So definitely communicating how you see as the best practice and sort of incorporating that into your process would be something quite important for a lot of the professional investors perhaps out there in the market to look up to. Coming back to investing in the public equity market, you are investing through stock market and you're a large cap investor, and that's different from being a private stakeholder in a business. So I guess a lot of our audience will be interested to know how you measure your sustainable impact, perhaps through your investing in a public market.
Well, public or private, all investments have impact. The question is, what is it, right? Not if there is an impact. So, in recognizing the subjectivity of whether that impact is good or bad, we actually just stay very focused. We keep it simple. We stay focused on, what's in our control, and that is allocating capital to companies that are better, cleaner, greener, more productive, more efficient, more competitive than their peers, because of, certainly not despite, their attention to their sustainability performance, and that they're rewarded by the market for doing so. And I guess I'll go back to that word, performance. That's how we keep it simple. So we measure our impact through the ability of these companies to use sustainability strategies to make these fundamentally financially sound companies even better through those sustainability strategies. So we look at both the sustainability risk side of the equation, and that's a lot of sort of you could consider sort of the more traditional ESG risk analysis. It's definitely important to have a handle on labor relations, to have good governance, to not have environmental liabilities, etc. And so we expect that kind of risk management from our companies, but honestly, there's not enough risk management and sort of staying out of trouble that's going to catapult a company into long-term sustainable growth. So that's where we're looking for companies that aren't just playing defense, they're playing offense. So in some ways, you could say that, yes, criteria around ESG risk management, you can measure that. How material is it to a company? Whether that company has the ability to manage through that risk. That's important. That's both art and science, though, in terms of measuring that. But then on the opportunity side of the equation, playing offense, that's where our framework that we call sustainable business advantages come in. And that's where we look for sustainability strategies demonstrably adding to shareholder value. And again, we keep it simple. We've got 3 drivers that we look for sustainable business advantage. The first is revenue growth. So you can think of that as a company that is either providing a product or service that, helps their customers be more effective, more efficient, or just solving a compelling sustainability issue and, their problem, being a solution provider and then being rewarded for it such that it becomes a revenue growth driver for that company. Second is cost improvements. And that's really a company that pays attention to its inputs, squeezes out efficiencies and increases their productivity in that way. And, why do we care as investors is because you see it in their margins. So a lot of times, this long runway of margin expansion, is an investment thesis that plays out because of the sustainability lens that helps us identify that. And then the third SBA driver is franchise value, what we call franchise value. You can think of that as the value of customer loyalty, the value of a brand, and you can think, say food and beverage or personal care, products. Really, it's the healthier for you, organic, clean label type products that are growing faster than everything else. So that's how we think about sustainability opportunities. It's like I said, making these financially sound companies even better. We do track certain ESG metrics like greenhouse gas emissions, like I said, diversity on boards, et cetera. And we're also able to drive impact in some of these areas through our engagement. Engagement as an active manager, it's not a quick process. Sometimes it takes years of collaborating with a company on a particular issue. But, we are able to seek this impact, and clearly we invest in companies that are sort of open to our input. And we think that that's aligned with long-term shareholder value as well.
Yeah, clearly on top of an already very long checklist for ESG considerations, the company has its own sort of proprietary framework to actually measure the tangible advantages those companies that are embracing those considerations actually gain profit and extend their margin from it. That's very interesting. And speaking of investing through public equity market, I guess it's quite one of the most heated topic right now for a lot of professional asset managers is whether should I engage with the underlying company or I should just leave them alone. Should I just divest from those holdings? Perhaps, Karina, could you share with us your own observation in whether, have you seen shareholder pressure becoming a bigger deal, in the investment community, or are we seeing more companies are still adopting this divest and withdraw approach right now?
You asked that question perfectly in asking, should I divest or engage? Because it's not an or, it's an and. It's just like, do I do ESG or do I have good performance? That's a false dichotomy.
Right. Looks like I asked the wrong question, but
that's all right. It proves
Perfect
the point,
example.
right?
Yeah.
So yeah, I mean, and I think that investors need both. You need the opportunity to walk away from an investment. If a company is not open to new ideas or, is not performing well, both fundamentally or in terms of managing their sustainability risks and opportunities. And, this isn't permanent capital. Permanent capital, it's harder to have a carrot or a stick, when it comes to permanent capital. So, our strategy, we tend to avoid divestment just by getting the research right, I think, at the outset, right? That we trust the management team, we trust that they will be long-term stewards of capital. And so engagement then, plays a big role both through dialogue and proxy voting. So you're right that engagement is important because the good news is, for active managers that do engage, we don't have to wait until proxy voting season, to make our preferences known. And I think that dialogue is important and to be collaborating with a company, actually telling them what they're doing right, in addition to, letting them know about things that you would like to see do better. And now, negative screening will likely remain important, for some asset classes, for some markets. But as we see sustainable investing continue to expand in sort of, areas of the market that weren't early adopters, in sustainability, selecting securities that are demonstrating that they're on paths of improvement from an ESG perspective, I think is also appropriate. So yes, all of the above, I think, is important in the investor toolkit.
Yeah, it's not about choosing one and ditching the other, but combine the different approaches and trying to bring out value from making those investments. I think you're spot on pointing out that was actually a wrong question to ask to begin with. But yeah, I think with all the discussions around portfolio and how to engage with the companies and how to incorporate those considerations, it's time to come back to you are being nominated as a candidate to become a board of director on UNPRI. So it's a global network for responsible investors, and perhaps you could tell us more about what is UNPRI and what's your plan if you were to elect it to come join the board of directors on a very esteemed organization. So perhaps what are the trends and requirements setting UNPRI setting for the investment community? Perhaps you can tell our audience in China about that.
Well, thank you for the question. Yeah, I'm very excited about this candidacy. So the Principles for Responsible Investing, sponsored by the United Nations, has played many very important roles in the sustainable investing industry over the years. I'm sure there are some signatories among your audience, and it's really helped with several things. It's a framework for reporting. It's helped many investors starting out in their responsible investing journey to structure and articulate their approach to responsible investing. It's actually helped us at Brown Advisory put our approach on paper. That kind of transparency is useful for our clients, as well as for us ourselves to benchmark our progress, because all of investing is a process of continuous improvement. And so the same goes for, activities around responsible investing. I think the PRI is also an important educational resource for sustainable investors, for all investors, actually. They have in-depth research reports, sector guidance. It's a collaboration platform. Their conferences and their working groups are really important sources of learning, both for those that are new to the industry, but also those who have been in it for a long time. They also, I think the organization brings together investors and stakeholders from around the world. So important to have these different voices and these different perspectives. And that's really important if the industry is to continue to grow and be effective. And while perspective is important, it's participation and action that's needed, right, in order to actually achieve our sustainable development goals. So what I'm really excited about is helping to widen this tent, bring more influential stakeholders, to the table, and on this journey, not again just towards sort of goal setting and reporting, but to accountability, right? So all signatories, actually all investors, whether you're a signatory or not, you're going to be required to be increasingly accountable to your employees, your clients, your shareholders, your consumers, regulators, all stakeholders, who really expect action towards sustainability goals. So I think the PRI is in a great position to be helpful to signatories, who are setting goals, increasing transparency, but also need to innovate, need to have a near-term action plan for outcomes that will be expected because of this increased accountability.
Right, right. And that process is evolving itself. So I think you pointed out that China actually in recent years have a couple of heavyweight asset owners also became signatories of UNPRI, such as Ping An. But then perhaps you can help us to understand better how can those institutional investors meet these requirements? I mean, it sounds quite demanding, and with those standards also evolving themselves.
So the standards, I'm sorry, let me just clarify your question. Which standards are you talking about? There are so many.
Yeah, meeting the UNPRI. I mean, becoming signatory
and
also keeping up the good work and remain on that list.
Right. Well, accountability certainly goes both ways. And I believe, I think signatories believe that PRI is accountable to being practical in terms of, those expectations and, the frameworks. And it's important to bring signatories along on the journey. I see this in the companies that I invest in as well, that, they literally need to find some full-time employees, to deal with some of these reporting mechanisms. And I say, I'd rather, that full-time employee go do those projects, go grow your revenues, go, increase, your productivity in some other ways. So, I think there's definitely an element of, we should acknowledge, the workload of some of these requirements. And I think it definitely has been. And I also think that it's incumbent upon signatories and those who are considering being signatories to provide feedback, as we have over the years. There's, especially as different kinds of signatories, we're expanding, the asset classes that are represented, the geographies, the different investment approaches. We can't take the same frameworks and think that will result in, transparency on a responsible investing approach. That you can't put it all in one blender, just as I was saying that, ESG is not one monolithic industry. So I think that we have to be flexible and help companies, and investors report according, better understand what's important for them to express, again, to those stakeholders that will be requiring accountability.
Sure. So contributions and feedbacks from the signatory community is also welcomed.
Absolutely.
Right. And moving on to sort of the most trendy topic right now. Right now, we have, all eyes on the Glasgow meeting of United Nations COP26. And it will be good to, Karina, have some understanding around what would be your top items or on the top items on your watch list for the upcoming COP26 meetings.
Well, I have a big wish list, but we'll see. We'll see what happens.
I'm sure it's not a short one.
as many observers, I'm sure. So this is now over 5 years after the Paris Agreement, right? Where back then the goal was to limit global warming to below 2 degrees Celsius, right? And so here we are at COP26, really focused on 1.5 degrees as our goal. So that really requires net zero greenhouse gas emissions within the next 30 years. That's what the science says. So I hope we can all look forward to more detail on those nationally determined goals that can help us reach net zero by 2050. But more importantly, perhaps, is what our nation's committed to doing literally in the next 5 years and within this decade to get there. And clearly, those will be big signals for ways to mobilize finance. Absent a regulatory environment, for private commitments to thrive, investors are a bit limited. But there's still a lot investors can do. But we'll be listening for the strength of policymakers' commitments, particularly in the U.S. and China. obviously very, very important stakeholders. But we, and trust, those commitments will build trust with the finance industry that, that trust doesn't happen overnight. And so we hope that, the trend lines keep going in the right direction. We also expect companies, a lot of companies we invest in, to come out with new commitment statements about their climate ambitions during this time. We'll watch those closely, evaluate those that robustness. I'll also say that this focus on net zero is absolutely required. I'd also like to see the flip side of that coin, because even if we get to net zero by 2050, we won't be able to adapt to a 1.5 degree warmer world unless we also preserve and protect the natural environment, and particularly our most important carbon sinks. The tropical forests, biodiversity, peatlands, all that. And so, we need frameworks that mobilize solutions that I think bring, governments, civil society, and of course, businesses together to create attractive vehicles to mobilize investment communities. Because you know what? Every business is dependent on nature. Like, think about the cost of goods sold. Think about the raw inputs for a company. You can call it, packaging or semiconductors or what have you. But you know what? You can also say trees and water
and air. Yeah.
Yeah. And materials. So we're all dependent on nature. And so, I'm looking forward to more, public-private partnerships, to bring, private financing, to achieve these goals, in time.
Yeah. There's definitely a lot to watch, and collaboration is the key here. I guess this is the moment that we have to stand together for this. I think that brings to the end of our discussion, and thanks, Karina, for your insight today. It's a pleasure to hear, especially your take and your observations on ESG investment and what to watch for the investment community. Thanks everyone for listening. Karina, do you have anything else to share with the audience?
Well, thank you, Selena. Thank you so much for your questions. I want to thank everybody for just engaging. It is such a good thing. We mentioned, I mentioned that there's different approaches to responsible investing. It's a great thing to just engage, ask the right questions. We're all learning together. So I appreciate your time.
Yeah. Thanks, Karina. Thanks again. Looking forward to good news coming from your side in terms of becoming actually on the UNPRI board. And I believe that will bring more influence, your influence to the global community. Yeah.
Thank you.
Thanks.